Welcome to another RTD interview. Today I'm excited to have returning guest, Mr. Lior Gantz, the founder of the Wealth Research Group. Today he joins us to share his thoughts on the economy, financial markets, as well as forecasts for the remainder of this year. And so I'm excited as always to have Lior join us because he brings a wealth of knowledge from a variety of perspectives. And so Lior, welcome to RTD interviews.
Thank you for having me back.
Well, I appreciate you taking time to join us here. As always, it's good to connect with you and get your thoughts on what's relevant, as well as what are some things that most people may not be talking about or looking at. And so I'm curious to hear what you're keeping your eye on these days. So before we begin, I guess let's start this off. We last connected, I think, springtime. And at that time, the banking sector was a problem as well as other subjects. But I'm curious to get your thoughts on what you're keeping your eyes on these days.
I think the most important factor that is still up in the air is real estate housing, because if we look at CPI, which was the big concern a year ago with CPI hitting 9.1% at the peak, that's mostly done. We're seeing a complete turnaround in CPI numbers. Now, CPI, granted, is not a measure of everyday inflation for most people, so that's not the point. The point is that it's a huge barometer for Wall Street, for investments, for banks, and that does trickle down to Main Street decisions at the end of the day. So that to me is trending well. So let's say CPI, 70% of the way there. Then you look at jobs. Jobs was the real problem for the Fed in terms of how hawkish they have to be. It seems to have normalized to a large degree. I would say 60% of the way there. And then the one that's just not turning around, there's just no buying and selling. The entire industry is frozen, is real estate, and that impacts banks as well. So to me, those two are the main concerns as we enter September, where there's so much debt that's about to be recycled, and we just need to see how that plays out. To me, that's the number one concern. Secondly is China entering a recession, and that's going to be a big one as we go into 2024. So between those two, those are the two economic things I'm paying a lot of attention to. In terms of monetary things, CBDCs are actually very interesting right now in terms of quote unquote interesting, because there's been a lot of advancements made by the central banks in the last month or two, which were unprecedented in their scope. Like they're really advancing CBDC. So that's a concern, because I would hate for them to continue rapidly on this, especially in an election year where this takes way more thought that needs to be put into it. So that's on the monetary front. And of course, geopolitically, Sweden just joined NATO, so it doesn't get any bigger than that. And that to me is critical as to how the war would continue from here.
Sounds good. Now, so let's jump right back into, I guess, the CPI figures. And so I'm curious to get your thoughts on that. And so based upon its extreme highs of last year, closer to 9%, now closer to 3-ish. So will it continue to trend downward, or are you foreseeing at the end of this year a spike up, or will the numbers stay low, or will they continue to trend back up? And will the Fed be able to actually get their 2% so-called mandate, in your opinion?
Yeah, I think that the 2% is gonna take a while longer. I don't foresee 2% until perhaps 2025, 2026 is more likely. But it's hard to project. Anything that's over a year is not worth even looking into. But certainly, I think that inflation is higher than normal, even if the CPI continues to trend down. That's one thing. Secondly, I don't think that if the Fed cuts, that they will continue to see these trending down of CPI. So to me, I think that they raise one more time in July, on July 26th. That's 6 days from this recording. They raise by another 25 basis points. That will take the Fed's fund rate to between 525 and 550. And I think they keep it there for the rest of the year. So that's on interest rates. I do think that in the background, there will be programs to help banks with with lending, but on the flip side, you can see that there's strict regulations right now on mortgages that are getting stricter. So it's becoming an even bigger problem to originate a mortgage in the United States. And the problem that the banks are facing, as you know, is that there's a mania in money market accounts. Everybody's in money market accounts. It's a $10 trillion or money market account. That's double the all-time high from before the pandemic. It's just insane the amount of money that's just earning interest on a money market account. People are not in stocks. They're not in real estate. They're in money market accounts, and that's insane in terms of the amount. Because if you think about it, every dollar that goes out of the banking system and into the money market accounts hampers the ability of banks to lend. So counterintuitively, the public is moving into money market accounts, and that's what's hurting the real estate market and the banking sector, and making this crisis more prolonged. But you can't convince anyone to buy stocks right now. Most people think that the market is artificially rising, and that there will be a huge correction or even a plunge. And so that's the result of this. There's so much distrust in this rally. So when you look at what the Fed is projected to do, if you look at the CME watch tool, the Fed watch tool, it currently projects that the first cut will be in March 2024. So who knows? But certainly that's what the market is pricing in, and that's how Wall Street is investing. And that plays into your real estate as well. Because if you think about the lending industry, it cannot function properly before they are convinced that the Fed is stopping the hikes. If they're convinced that the Fed is done, then they can start lending. Because if you lend and rates start to come down, that really becomes a very profitable business.
Now, I'm curious to get your thoughts. You mentioned about, you're anticipating one more hike next week, give or take, and then a pause until the next projected Fed, I guess, official pivot when they start to cut rates. Now, between now and then, is there anything that could occur, in your opinion, that could lead to them needing to cut sooner? Possibly. Sure. Anything you think on the horizon that could definitely cause them to pivot a lot faster than this suspected pause?
Yeah. In September, there's a lot of debt that's coming due. And if the market is unable to refinance it at an attractive debt levels and monthly payments, you're talking to office buildings, commercials, residential. There's so much coming due in September. Then you will start seeing either distressed sales, bankruptcies, or otherwise. And remember that these people also are part of mainstream America. They're part of small businesses, and small businesses already are dealing with business loans upwards of 20% interest. If you now need a bridge loan from a bank, let's say to get through the next 3, 4, 5 months, you're buying equipment, you're renovating, whatever, that debt can go up to 20 to 25%. And that's because the banks just don't have capital. Everything is in money market accounts. So I think that in September, if we get a lot of distress, which becomes a problem now for Washington, and in an election year, I think that they will start putting pressure on the Fed to, I'm not sure if they will cut, but I am sure that they will facilitate all sorts of programs that provide liquidity. So I do see that coming, and I think that they will take a firm stance on not cutting. And that will be like the last thing that they do, in my opinion. So don't expect cuts in 2023. I would say that will create a lot of friction and a lot of uncertainty. So they would rather stay the course and let what they call the lag effect or higher for longer play out in the economy. That's what they really are interested in. And I don't think that recycling debt will interfere with that. I think that they will just provide liquidity in other forms. But I'm convinced that they won't cut in September.
All right. Now you mentioned real estate, and so well beyond, I guess, the residential side of things. Are you referring to, interest rates causing slowdown in residential? But what about the commercial real estate? It's already a problem as of now. Like, could that also factor in to more of the housing and commercial real estate distress that we're seeing now? You think?
For sure. I'm invested in commercial and in office and logistics and in industrial buildings through funds that I'm an investor in. And when I get the quarterly reports, it's basically the vibe is this: sellers do not want to sell because they feel like they've gone through the jungle here, and that they're just about on the other side of it, where where their clear turquoise water are. So no reason to sell now. You already been through all the problems. Now you just wait it out a little bit more, and the buyers, they think that the jungle is not just around, that the turquoise water are not just around the corner. That there's a lot of more machetes that need to be chopped in the jungle. So they don't want to buy, they don't want to sell, and prices are not coming down. So it's just a big freeze. That's what's happening in real estate. And the only deals that you really do see are from real distressed motivated sellers. So people that have other emotional problems that have to do with the property, not just anything that's strictly financial. Maybe it's a family-owned complex where the inheritors are fighting each other, and they're like, let's just sell this thing. We can't get along as a family. Or maybe it's a fund that's 5 years old and it needs to liquidate as part of its mandate, and it still has like 2 portfolios on its balance sheet, so they need to sell them to the first taker. They can't wait anymore by their mandates. But apart from those in the fringes type situations, most people, individuals that locked in mortgages in 2020 and 2021 where rates were very favorable, they don't want to sell. And buyers that are saying that, hey, prices are not coming down, and all of these people are seeing 40% rises in their mortgage rates, I'm sure that they can't afford it, so I'll just wait it out. They're not buying. So unless your kid is starting school and you want him to be just in that school district, you're waiting as well. And it's a big freeze. That freeze is not healthy for the economy. Housing is a huge part of the GDP in America. So, and obviously elsewhere, but in America, where 75% of millionaires have come from housing, I can tell you, housing is critical. So I do see a problem here, from residential to office to commercial, all, each from his own perspective, and what they need is sophisticated liquidity solutions. Some of these big ones, like multi-complex 300-400 door multifamily residential complex that are for sale, those come with rate insurance. So the owner would ensure that if his interest rate payments are going up, he can cap them. That's a very standard in the industry. You can use insurance for that. But the average person, he does not have mortgage insurance, and therefore he moves with whatever the Fed is doing. I think, like I said, that the Fed is going to raise in about 5 days from now, and after that, it will probably just keep it there, and the market will start to price in that lower rates are coming because of low CPI, and that would help alleviate some of these pressures coming in September and onwards. So I don't foresee any catastrophe. I see more drama, but not catastrophe.
All right, sounds good. Now, you hinted at earlier the CBDC, and so on top of that, or I guess underneath that, or however you want to look at it, the Fed now was initially launched July 1st, sure. And so looks like a lot of institutions are plugging into it, and so I think that's the foundation for what would probably be a future CBDC in the U.S. At some point in the near future. But what are your thoughts on that? And will the CBDC ramp continue to pick up momentum? And a lot of people say it'll fail, won't work. But then again, I think if things become as bad as a lot of people projecting that they will, people will be more than willing to roll into CBDC just because that'll be the best way of, I guess, trying to reassure their financial matters if they happen to have some bank losses or whatever. So what are your thoughts on the CBDC? Will it pick up? And, when do you see it coming here in the U.S., if at all?
Okay, so a few things about CBDCs. First off, I created two reports that I think are critical for this discussion. So as part of listening to this interview, I really think that if you download wealthresearchgroup.com/CBDC and its companion report /CBDC2, the number 2, I think those are extremely comprehensive, and anyone interested in understanding CBDCs from China to West, United States, has to know and has to read them. They're each like 5 to 6 minute reads, and they are very comprehensive. They are basically congested after reading IMF papers, BIS papers, the People Banks of China papers, and the Fed papers, ECB papers, Bank of England papers. Everything that has to do with CBDCs congested into all the updates. So those two, please read them. On top of those, I want to update you on everything that's happening in the last month. FedNow is a payment app, basically. But it's a precursor for rolling out CBDCs. So in and of itself, it's not a CBDC or anything like that. In terms of its adoption, it's been adopted by a few thousand businesses, so nothing overwhelming. But what we do see in the last month and a half is the formation of framework for the future of CBDCs. There are two types of CBDCs that people need to understand. One is wholesale CBDCs and one is retail CBDCs. The wholesale CBDCs are CBDCs that are meant to be used by governments and central banks among themselves and between themselves and the commercial banks. So these are CBDCs that will never end up in your possession. And that's important to understand. They are just a blockchain version with faster transaction settlement time, more trustworthiness, etc., all the features of blockchain and of digital transactions that can replace a legacy system like the SWIFT and can override the sanctions that the U.S. government is applying on 40 countries around the world right now. And that's coming. That's for sure the first step here. The wholesale CBDCs will be part of how central banks buy foreign reserves of each other's currency, how they settle, how they buy oil from each other, weapons, military equipment, commodities, agriculture commodities, and the works. This is coming. This is in development. It's not hard to implement, and it doesn't require popular public opinion or anything of that nature. So those are coming. Like I said, the benefits or the drawbacks of these will probably not be felt much by the public. Where the public is scared and cautious and doubtful and suspicious is about retail CBDCs. These are CBDCs issued by your central bank, given to your commercial bank, and then onto you, or the reverse, given directly to you so you can deposit in your commercial bank. How would money end up from the government directly in your pocket, you ask? Well, first off, retirees get their Social Security, Medicare, Medicaid. So that's a great way for the quote unquote, for the government, great way to put CBDCs into the hands of the people that won't say no to money. And then it's in the banking system. Now, just understand what I'm saying. A retail CBDC is now making your money a government liability. And the custodian is the Federal Reserve. So that's a huge change. And the reason that is a huge change is because now you've kind of created a system where the Federal Reserve is the custodian and not your commercial bank. That's becoming an intermediary. So Wells Fargo Bank of America, Chase, etc. Instead of them being the custodian, you are now working with the government in terms of your finances, and that introduces a whole slew of problems with privacy, with how much power they can have over your life. And just to be clear, the CBDCs are not to be rolled out and replace paper money. They are to accompany paper money. No central bank is even considering putting paper money out of circulation. In fact, they see paper money as essential. So just to say that off the bat, but the fact that you will now have a bank account with the Federal Reserve is a very slippery slope. And that's what people are concerned with. They're, in China, for example, where it's much more likely that the government will abuse this power. They can, as you well know, they can implement all sorts of measures. For example, using their gazillion cameras that are taking scans of your face. If you do something like pass on a red light, you can see like 2 yuans drawn from your bank account, and with a little memo that says you just passed on a red light, and that's it. Like, it's gone. There's no debate. And of course, I don't think that something like that is coming to the United States, but just to give you an idea of how much this can become centralized and a problem. And the retail CBDCs in China are definitely coming soon. It could be a year or two, but they're coming. They already are piloting it on 128 million people. So that's a huge pilot. That's, if that pilot was in the United States, we essentially everybody would already transact in CBDCs. So that's happening there. Because it's part of their culture. They are just moving into a culture where the citizenry is going to be much more obedient to the government as the years move on. Europe, Bank of England actually likes the idea of retail CBDCs, and because it's not part of the euro, it has advantages where they don't need to ask anybody else. So they might be rolling out something fairly quickly as well. So let's say 2 to 3 years. The ECB, that's more tricky because you have many different nations with many different agendas. And in the United States, right now, everything that I look at tells me that it depends on whoever is president. Because if the Democrats win, it will be faster. If the Republicans win, it may be that this gets aborted. The retail side gets aborted for whoever is a Republican president. And then let's see what happens 4 years down the road. But if a Republican president tells the Fed, hey, put this on the back burner, I don't want to keep hearing updates on this. I need you to focus on CPI or this and that, whatever. Then that's what will happen.
Yeah, they laid out a wealth of knowledge right there. And so when you mentioned piloting, the digital yuan being piloted in China, first thing came to mind here is that what they're piloting here is UBI. So there's a lot of counties and cities and states that are piloting what it would look like to give people $500, $1,000 a month. So that lets me know that that's a part of the plans in the future. But I'm curious to get your thoughts on what's happening with the BRICS. And so it looks like next month they're going to be meeting, and there's a lot of talk about a gold-backed currency. Is that valid? Is it propaganda? What are your thoughts on it? And if it is true, or just a mention of gold, how will that impact the metals markets in the near future if they happen to come out with something like that, in your opinion?
Yeah. Look, first off, the BRICS are an association. They're nothing formal. There's no agreements, contracts, pacts, or anything binding between these 5 nations. So they're just basically a think tank. You can think about it this way. There's nothing that really connects them. There's no central governance or anything. It's not like a European Union at all. So to think about them rolling out their own currency, it's kind of, I think it's I wouldn't want to call it propaganda, but it's far-fetched. It's not happening. So That's a kind of a short answer, but it is the truth.
I mean that's real.
It's like, I mean, they're not they're not doing anything gold backed, or it's nothing. I wouldn't pay too much attention to it. I would say that what's more interesting is the paper that the Bank of International Settlement just put out about the future of money, because they actually were talking about a key for the future of monetary policy, and that's tokenization. So with tokenization, you can actually create gold-backed transactions, and you don't even need a central bank. And I'll give you an example. In the future, and this is the near future, this could start rolling out very soon. If you have, right now, if you have physical gold or physical silver, it's not like you can waltz to a bank and say, hey, here's 50 eagles, I want to get a loan. Collateralize these coins and give me a loan to use it. And by the way, I'm also, I have a business and I want to get paid in ounces. I don't want to get paid in US dollars. And those options are obviously non-existent today. There are companies that would lend money to you if you store physical with them. So there is a little shadow economy for that, but nothing incredible. Also, there's not a lot of tokenization. What I mean by that is, for example, if somebody owns a piece of art, or if somebody owns anything of value that he doesn't want to sell, but he wants to collateralize, he can tell a bank, hey, how about you tokenize, you get tokens from my 6 TVs, my furniture, everything. If you appraise it, it's like $50,000. So why don't you tokenize that and then give me a loan against it? Today, a bank won't do that. But in a tokenized world where that value can float and act as an asset, that will happen and could happen. So the future is tokenization, and there's so much that can be revolutionized with this. And when I look at the big picture for this, I think about African countries, that the 54 African countries that are the fastest growing in demographics in the world, and they all have phones, but they don't have any banking culture. And so tokenization for them can be incredible. And by adding Africa to our global economy, we can probably add like $10 trillion to annual GDP. Everyone would benefit. So my point is to say that I think you should focus on the fact that you can probably start transacting in gold-backed tokens that are very reliable through the banking system, and that will happen in the near future, because tokenization is the top priority for central banks. They really see the benefits of this in international trade.
Now, what are some of the cons to that tokenization that will be controlled, I guess, instituted and held by through the regulators, through the central banks of the world, as well as other major institutions? What are some of the drawbacks to that, you think?
The whole idea behind Bitcoin and decentralized economies has been, hey, let's take currencies out of government and have so it looks like it's not happening. There's a lot of innovation in the DeFi world. So I think that what will end up happening is that governments and central banks will continue to be the monopoly over most of the currency in circulation. I don't think that they have that they can stop Bitcoin or currencies like that, but they can make it less advantageous to transact in. But they will take the innovation that the DeFi world presents, because there's a lot of amazing things, smart contracts, etc., that are going to be part of our future, but they will incorporate it into their own system. So I think that the con, quote unquote, is that this utopia of decentralized economies around the world is not happening. But on the flip side, I think that the monetary system is going to open up to many more avenues that were not available for the average person before.
Understandable. Now, as we draw towards the end, I guess, what do you keep an eye on as far as opportunities and possibilities out there for people to actually take advantage of these things that are underway right now? What do you keep an eye on?
Yeah. Look, with the Wealth Research Group, with our free newsletter, I published my personal portfolio in October of 2022, and I republished it in January of 2023. Since October 2022, that portfolio is up 77%. That's why I tell you that money market accounts are a mania, because while the markets were doing between 45 and 75% since October, money markets have been giving you just over 6%. And so the first thing that I'm watching is that my portfolio, which you can still access at wealthresearchgroup.com/portfolio. Most of these companies are not favorable right now to create new positions in. So the first thing I'm watching are all of these earning calls. I've done 3 already. I have 55 more to go because we just started earnings season, and I'm watching which companies are going to be attractive, because the market has run up a lot. Not everything has run up, but a lot has. And so I'm looking at a few ones that I think are extremely attractive. But out of a portfolio of 60, if you have like 5 or 6 left, that tells you something. So I'm definitely doing that. And if you're a subscriber to our newsletter, you're going to get updates on those. So that's with regards to stocks. And with regards to opportunities in terms of commodities, if the Fed does raise rates in July, like I said, in a few days from now, and it also kind of gives the hints that it was the last rate hike, I think that you will see gold trading over 2,000 very shortly. And that's interesting, and I think that it's a rally. So because the next thing that the Fed will do is going to be a cut. If they just ended rate hikes, I think that gold has a real chance of going to an all-time high by March of 2024. So I'm definitely watching that.
Interesting. So that means silver also.
Over 35 by March could be easily done.
Interesting. That's definitely going to be some interesting unfoldings as we move forward. But Lior Gantz, as always, it's good to have you on the show to give your thoughts and analysis on things, as well as forecasting what's to come. And so I appreciate you for joining us. And as always, wealthresearchgroup.com. People can find out more and sign up for those newsletters, as well as get some of those reports there. And so other than that, Lior, I look forward to having you on the next couple of months and see what you're thinking about then. And we'll find out about these additional hikes or not and things of that nature. But definitely going to be some interesting times ahead. And once again, thank you for joining us on RTD Interviews.
Thank you for having me.